Welcome to our final breakout session of Ignite Live 2020. We're grateful that you could spend the time with us today. I'm Bill Johnson, Head of Data and Analytics here at Equifax Canada. I'm excited to talk to you today about our pathway to recovery. We've spent the last couple of months really focused on managing risks. As our economy reopens, we're starting to see businesses turn their attention to growing. We understand there's still a lot of anxiety out there, but there is a lot of opportunities for people in the marketplace. So what does growth mean in a post-pandemic world? Hopefully you were able to hear Doug Porter earlier today where he talked about this idea of a K recovery. So there's a large population of people who will recover very quickly from the economic slowdown, and some may not have even felt an impact. On the other hand, there's another group of people who will not recover as quickly. It's going to take them longer, probably in the service sector, probably part-time employees, probably younger. I don't really remember the alphabet of economic recovery, but I do know this is going to feel something like a recessionary recovery. We're likely to see unemployment rates at levels that would typically be part of a recession. Pandemic or not, the key elements of growth are still the same. The economy is really the key here. Consumer demand and their ability to want to and buy your products is really what's going to drive growth. It sets the parameters of how much growth will be available, how big the economy will be. But in reality, there's things that individual organizations can do to try and grab more than their fair share of that growth. Product innovation is one such example. If you think about Uber and Airbnb and how they made this big impact into industries that were quite well established, they grabbed a huge part of the growth and a huge part of that marketplace by offering something different. We're seeing something very different, very similar with fintechs today. They're finding underserved segments of the marketplace, and they're really offering up differentiated services and products to help gain that piece of the marketplace. In terms of credit, we always talk about risk as well. So are you willing to buy deeper? Are you willing to take on more credit risk? It's an easy way to grow. You just get more approval rates by approving more people. But there's a lot of cost there. I, for one, had the privilege of inheriting a portfolio that decided to use buying deeper as their strategy. On the upside, I learned more about risk in a couple of months than I probably would have in years in a normal portfolio. There is an opportunity there, but there's potential long-term costs. And so managing that risk, particularly in an uncertain environment like we're going to have in the post-pandemic, really makes that a bit of a challenge, but it is an option. And finally, marketing. There's always an opportunity to use marketing as a way of attracting new customers and driving more growth. Being able to differentiate yourself in the marketplace. That could include things like strategic partnerships. It could include very targeted offers that really address key parts of the marketplace and offer up your differentiation that will make a customer want what you've got to serve. These things will help you grab more of the share. But in reality, it's the economy that's going to really drive the amount of growth that's available to you. At the end of the day, it is about the economy. And I know I'm an economist saying that, but really, it is a core part of what you're going to see from a growth perspective. If we look back into previous recessions where we've seen unemployment rates in around 7 or 8% like we expect going forward, we've seen a really close connection between both the labor market and consumer credit growth. We've really seen that as unemployment rises, you start to get a situation where people are going to cut back on their spending. They're going to use less credit. We saw that with the financial crisis for sure. It took a little while, but over time we really saw a very close connection. The most recent example really is Alberta. So Alberta was really the darling of the Canadian economy going into 2014, even into 2015. We saw very, very low delinquency rates, and we saw really strong credit growth. As oil prices really started to drop, they started to move into recession. We saw very quick deceleration in credit growth. We saw delinquencies rise, we saw bankruptcies go up. So it went from being the strongest market in Canada to actually one of the weakest. And that really reflected the fact that they just stopped growing. People stopped using credit. To the point in 2016 where they virtually had no growth at all for credit. It recovered a little bit going into 2018 and into early 2019, but as the economy started to slide backwards again, you very quickly saw another deceleration. So really that level of unemployment, the strength of the job market is really what's going to drive what our future looks like even in this post-pandemic economy. But to know where we're going to go, you really need to understand where we were. So going into the pandemic, we already were on a very specific trend. We had experienced a very long credit cycle, really right back to the financial crisis. We've seen really strong growth in credit across the Canadian marketplace. We've seen some wobbles along the way, but in general, it's been really, really strong. And there's been a number of factors that really drove that. What we've been seeing more recently is a little bit more of a slowdown. And so where we saw all of this anxiety around debt to income and debt to income was at record levels, the reality was People were making their payments. Delinquencies were going down and bankruptcies were at historical lows. Mid-2018, we started to see that change. We started to see delinquencies rise. We really started to see consumer proposals accelerate very, very quickly. And we started, particularly in the non-mortgage side, to start to see credit slow down. We knew that we had the stress test in the mortgage industry that really impacted 2018, but by 2019, even things like auto loans, credit cards were really starting to slow down. So even pre-pandemic, we were already starting to see a change in direction. And there's a number of factors that both supported this long credit cycle and really what's going to dictate how we move forward. In terms of the credit cycle we went through, there's been a number of key things that supported it. Interest rates were really at the core. So we've seen interest rates from a Bank of Canada perspective below 2% since 2009. So over 10 years of incredibly low interest rates. Rates that we had never seen prior to sort of the financial crisis. That's really made its way into the mortgage industry. Car loans, where we were able to do 72, 84-month terms, was really driving demand for credit. Another really core part has been population growth. Canada has been welcoming about 300,000 immigrants every year. That's been a really important part of our ability to grow our credit base. We've seen growth in people, segments like seniors, where we've really started to see a different change in behavior. In reality, when we look back over the credit growth we've seen over the last couple of years, 38% of that actually is coming just from the fact that there's more people out there, not even that they're doing more. Immigration has been a really core part of that. And even behind that, again, has been wealth. And so we've seen really strong financial markets and a really great housing market that have made people feel wealthier. It's made them feel more confident about their ability to take on these big purchases. And so we've seen this great growth in wealth and income that's really helped people drive that forward. And finally, the economy. Like I said, it all comes back to one basic fact. The economy has been really, really strong in this recovery. We haven't seen really high growth rates in terms of the economy, but jobs and unemployment have gotten to really low levels. And so we've seen a really stable employment market that has supported the ability for this credit to grow. Needless to say, there have been some wobbles, and there's been very clear headwinds that have created that. Regulations has been the core one. So many of you will be aware that the mortgage stress test really came in late 2017 and then into full effect at the beginning of 2018. That had a really profound impact on the mortgage industry. It went from being incredibly robust and growing really, really quickly to really slowing down and actually becoming one of the slowest segments of the marketplace. So we saw this impact of regulation. We've started to see that weighing itself out, and so 2019 was starting to see some recovery in the mortgage industry, but we know that the regulations were critical. We talked about Alberta, so we know that there's regional challenges. So while the Canadian economy is doing really well, there are marketplaces that aren't performing as strongly. So when we look at things like Alberta and Saskatchewan and even in Manitoba, their growth rate in credit has been a lot slower than we've seen nationally. And while it doesn't seem like a huge difference, when you think that particularly Alberta was a growth leader, it really is a fairly significant slowdown. And so we see these regional discrepancies that have been driving the market. And while interest rates were really helping the marketplace in terms of the long term, we have seen the increased interest rates from 2017 were starting to impact it the other way. So if someone had a large home equity line of credit balance, all of a sudden you have these higher interest rates, their payments went up. We saw a lot of strain on that base, which meant they weren't able to buy more stuff. And so people with large HELOC balances started to slow their credit down. We also saw that in terms of the autos. So new cars were selling at 2 million units per year, which was an unheard of number. We started to see that slow down as they weren't able to offer these long terms that made the monthly payments affordable. What we saw in the meantime was a shift to leasing as they tried to compensate for the monthly payment using leasing, but that's not always geared to the general population, which means we just saw a slowdown. And so there were these headwinds in the marketplace even before we had any kind of pandemic impact. So when we try to understand what was driving the growth, we looked at things like income, debt to income, wealth, and what we've really seen is actually it's been higher income, wealthier people who've actually been driving most of the credit growth for this cycle. We saw that even into mid-2019 where really it was these people who had high incomes that were really the ones growing credit the most. And at the lower end, it was very, very low growth actually. So we know that it was really isolated and we saw this wealth impact happening. The interesting thing, and it feels a bit of a dichotomy, is actually the people with the highest debt to income were also the biggest source of growth at the same time. A lot of that just reflects the fact that these people with high incomes are taking on larger mortgages. We talked about how low interest rates were, which means the cost of those mortgages is relatively low, so they can afford the monthly payments, but their debt to income looks really high. Again, it's another reason why that debt to income measurement really isn't as effective as it used to be. So we do see, and when we think about the impact of COVID in the marketplace, it's really not going to be addressing the high income people. It's really at the mid to low income. And so we do see a lot of the growth was really coming from a group that will be less impacted by COVID. The one interesting fact is, as we talked about this slowdown in credit, we started to see that amongst the high income even in the last half of 2019. And so we've already seen that group starting to slow down regardless of the impact of COVID. So the one real source of strength was already starting to self-correct even before we saw the impact of the shutdowns. We were in this process where things had slowed down. Mortgages were starting to come back. They weren't quite back to the pre-stress levels. We saw things like car loans were really starting to slow down. So we knew the marketplace itself was starting to change. And then everything changed in terms of March and April once COVID really kicked in. And so it seems like a lifetime ago, but really we're in a completely different environment today. And any trend that we saw prior really isn't as relevant as what we've seen over the last couple of months. When we look at credit inquiries, it's really the easiest way of measuring consumer demand. This is how many people are out there looking for new credit. And we saw an incredible drop-off very, very quickly as we headed into late March, early April. So as the economy started to shut down, as malls were closing, we saw fewer and fewer people looking for credit, not surprisingly so. We started to see some sectors really impacted, and those were the ones dependent on physical locations. So when you think about something like a telephone, if you want to go into get a new mobile phone, most of the time you were going into a mall and you were going to a store and you were buying it. As that shut down, you really started to see those kind of industries slow down. Same with credit cards. Something like mortgages took a little bit of time. So the first couple of weeks, actually, mortgages held on okay. But eventually, they actually fell into a similar trend and really saw a very significant drop-off as even open houses and the real estate market shut down. So we saw this very, very quick and rapid deceleration. We've started to see recovery, and really it's been very, very concentrated in key markets. Mortgages, as we talked about, has really recovered well, and as a matter of fact, is actually now above 2019 levels. It's got to do with a couple of things. Housing market itself has reopened, and we've seen resale homes hitting record levels over the summer. But we also have refinancing happening. So very, very low interest rates mean people are saving money by refinancing their mortgages. So we saw this really big push into the mortgage industry. Auto is very interesting in that actually it got back positive faster than anybody. So in June, we actually saw more activity on the auto financing side. It's since come back down, and it's a little bit below last year, but it's sort of flattened out just below where it was. So again, it's recovered from what were really, really big declines, particularly as dealerships closed. Where we continue to see a bit of a lag is in this credit card and more into the telco space. So again, these retail-oriented environments, they've recovered much slower. So while they are better, they've come off very, very low levels of sort of minus 50% drops. They're still well into double-digit year-over-year declines, even through the end of the summer. So we're starting to see those recover much, much slower than we've seen some of the other product groups. We went back and looked, and so we had talked earlier about how high-income groups were the ones who were actually growing prior to COVID, and what we've seen is they've been the least impact, not surprisingly so. What is interesting is the very low-income group actually had the most significant deceleration in terms of new credit balances over the last couple of months. What's interesting about that is for many of those, they actually probably had higher disposable incomes through the pandemic, given some of the government support programs. Given that they didn't have places to spend, and given that you weren't going to put on a trip to Jamaica or Florida on your credit card, they weren't building credit up the way they were before. And so that's where we've seen a very quick deceleration and, in fact, paying down of their balances as they've used some of these government support programs. What makes this interesting as you think through the growth trajectory going forward is, again, the groups that didn't have a big impact remain a very significant part of this marketplace. And so the opportunity to grow remains with them, given that they won't see the same kind of slow recovery, and they will be on the V side of the recovery as opposed to the bottom end of the K that we talked about earlier. One thing that we have seen, and not completely surprising, is actually changes in credit score. So as you start to think about that notion of buying deeper, it's important to understand the dynamics that are driving this credit score. Most of you would think back, well, it's got to do with these payment deferrals. People are getting let off because they don't have to make their payments. In fact, it's got very little to do with payment deferrals. If you actually look at where the real improvements have happened, they're at the higher scores. So the prime and super prime customers have really seen this really strong growth in their credit score. And it's really about dynamics. So if you think about what drives a credit score, you have lower balances, lower utilization, fewer credit inquiries, fewer new accounts. So key drivers of a credit score have all improved over the last few months. What's important to watch for is how many of those will be actually temporary changes. And so as things go back to normal, your credit card utilization will get back. You'll start to open new accounts. And so as you think about your buying deep strategy, you got to understand whether or not that group is going to be benefiting from this sort of short-term period, particularly with government subsidies in place, and whether that's something that would be sustainable. So again, it creates an additional risk when you think about this buy deeper process. So we've sort of seen where the market came. We've sort of seen how it went from what was a slowing marketplace, particularly for things outside of mortgage in 2019, and we saw this massive drop-off. Where do we go from here? And there's a number of things that are going to determine what growth looks like in the next couple of months, and actually for the next 2 or 3 years, given some of the factors behind COVID. We do know that there's an underlying strength, and we'll talk a little bit about some of those key factors, that will support growth going forward. But some serious headwinds remain and will really influence how you're going to go about attracting customers and driving these new balances. So if we focus on the positive part, again, we had talked earlier about a lot of the growth came from higher income, and so they've been much less impacted. So that growth trajectory will return much quicker. In some ways, it'll be stronger because for this period of time, many of them will have better disposable incomes. Fewer people driving to their jobs, fewer people taking public transit. So there will be actually some better disposable income for many people. So the fact that you have this big population of people who have higher incomes that haven't been impacted will create growth and generate fairly quick returns. The reality is, and we talked a little bit about the younger borrowers who are impacted more by COVID, and the reality is they've been a very small part of growth for some time now. Even their average balance outside of mortgages have actually not been growing very quickly. And on top of that, you haven't had a lot of younger people coming into the marketplace. And so the younger population hasn't been a key driver. Where we've really seen good growth are seniors. Seniors continue to be a key source of new balances, new accounts. So when you think of that, again, you're going to have a core group of people who will be much less impacted by this post-recovery period. We talked about interest rates was a key driver of the long-term credit cycle. In reality, they are going to be at these very, very low levels for the foreseeable future. There are very few compelling reasons for interest rates to rise. If you were able to watch Doug, he would have talked about this idea that, having very low interest rates creates this big risk of inflation. But right now we probably have just a bigger risk of deflation. So there's really these two factors that are going to have the Bank of Canada just waiting. So we don't expect interest rates to go up, which will continue to fuel the mortgage market. We continue to see very, very low rates, and we continue to see more use of refinancing. So mortgages will remain really strong and a great opportunity for growth. And those low rates are really going to translate into more new car sales likely. So again, this notion of the longer term. So what we saw really happening was as interest rates went up, the lenders had to shorten their terms back because of the cost of funds. So all of a sudden, you could get 84 months for 0% the way you could, previously. So people either flipped to leasing to get lower payments or frankly went to a used car or didn't buy at all. So you saw this change in demand that really happened. Now with low rates, we've already started to see these 84-month terms come back. So we see this opportunity to really start to grow again in this new car market that had been fairly slow over the last year or so. But again, this recovery is not going to be simple. It's not going to be even. When we think back to the words we used at the beginning of the pandemic, toilet paper, unprecedented, just became part of your conversation every day. In the recovery period, that word probably becomes uncertain. There's going to be a lot of uncertainty about how this economy recovers. So again, while the young group is actually a relatively small part of growth, it's not just about today. So people were going to buy their first car, they're going to get their first credit card, they're going to rent their first apartment, even buy a small condo. That stuff could start to be delayed. So as they build their credit, what could happen in 2 or 3 years' time may be delayed because of the fact that today they're going to have to pause and wait. So while yes, the young aren't driving a lot of the current demand, it could actually delay some as they move into more of the primary credit age group just because of that challenge. The other interesting part is really around small businesses. And so we're all seeing the headlines about the percentage of restaurants that may not make it past November and a lot of sort of alarmist headlines. Small business owners are really feeling the strain. Many of them not use just business credit, but they actually use their personal credit for business purposes as well. And so they're really going to have to sort of step back. So you could start to see small business, which is a relatively significant component of the Canadian market, really start to defer some of their purchases. And again, using their personal credit for small business may become less important to them because they just don't want to take that risk. So again, another core part of the base where many of us really want to actually win in. What's really going to be an important component of this is immigration. So through no choice of our own, immigration has really slowed down. So the idea of getting 300,000 or 350,000 new Canadians in 2020 and probably 2021 is highly unlikely. So yes, that has an immediate impact. They're not going to open their first credit card. They're not going to get their first cell phone. Things like that will be delayed because they're not going to be coming in now. But if you think over time, it becomes even more important. So it takes time for a new immigrant to build their credit. It takes a while for them to get a credit card that's larger, to get from a prepaid phone to a postpaid phone. That's going to start to be delayed. So the longer these people take to come in, then it takes time for them to build out their credit profile. So this impact of lower immigration that's COVID related actually will drift well past 21 and probably even into 2023. So it's a part of the market that many lenders have really focused on. This new to Canada is such an important segment for so many businesses. It is going to really go through significant change over the next 24 months that will have an impact on growth patterns going forward. And the last one was really around consumer confidence. And so this is not going to be an even recovery. This notion of a K recovery that we've been talking about means that there's a group of people who will be doing really well and a group of people who will not be. But in there, even the ones doing well, we've already started to see some of our COVID daily numbers rising. You're starting to see anxiety as we return to school. As we do a lot of our normal things, you're starting to see anxiety rise. That likely puts a lot of consumers on the sidelines who are going to say, well, I'm not going to buy this big thing right now. I'm going to wait till I know what's going to happen. And so consumer confidence, and I believe Doug had one of his slides that showed it has recovered from the worst part, but it's already started to slide back down a little bit because it's just going to be a very uneven process. That's going to require patience in terms of growth. You're going to put a strategy in place that might be working really well and then it'll stop working. It may not be a reflection of the strategy. So quickly converting in between strategies might not be the right call, just given this flexibility and consumer confidence. So where do we go? How do we actually help ourselves grow in this environment? There's a couple of things to think through. Quite often we get into a position where we really focus on a product. We're trying to sell one individual thing, a car loan or a credit card. It's going to be really important to think about solutions. Everyone's situation is going to be a little bit different. Trying to plug in one specific product at one specific time is not going to be as easy as it was before. The notion of consumer confidence is going to play on people. They're not going to be looking to change. Sort of behavioral science says that people are going to sort of hunker down as they go through this period of uncertainty. Being able to position, whether it's multiple products or the way you combine offers, to address different situations for an individual will help drive better response rates and drive more business. It's understanding where they are and what they're doing. It's understanding the right language. So understanding that even if I'm okay and I have no job issue, does not mean I'm not going to have some anxiety. So how do you ensure that your language is around helping and supporting at a time where anxiety is really going to be high? The other thing that's going to be really, really important this time period is all around digital. We've seen an incredible acceleration to online. It's been required. People shut down their physical location. There was no store or mall to go to. So we've seen this really sharp drive to online. What that means is when you get in there, you need to be able to align into their digital journey. This isn't about trying to plug in what I do today into what they're trying to do online. It's about being part of what they do online. One of the things we've been working on with customers is something we call pre-qualification. So how do you allow someone when they're on a website to very quickly understand whether or not they would likely get approved for something? Because no one's going to want to go through a whole application process, only be told at the end, oh, sorry, you were declined. This allows them to upfront understand what their options are. So again, it becomes part of that process. We've also spent a lot of time around authentication and how do we make it easier for you to authenticate somebody on the digital platform. Again, if someone has to leave your application and go somewhere else and do a bunch of stuff, it just feels too clunky. And so a lot of times you're just going to drop out of that process. So how do you make sure that these offers and products are a core part of that digital process? And finally, we can rethink segmentation. The amount of data and the new analytics capabilities that are in the marketplace today allows us to think differently. This idea of one-to-one marketing that we used to talk years ago is going to be more important than ever, actually, because everyone's situation is going to be a little bit different. So how do you start to understand where I live, what I do, What are my behaviors? How did I cope through COVID? What was I like before, during, and after? How do I piece these things together to really understand what's core and important to me, and more importantly, what my behavior looks like? As you think through something like deferred payments, what we did see was a lot of people who would take a payment deferral and make their payment. Well, what a great measure of risk aversion. That person was so risk averse, they were so afraid of missing a payment that they actually did a deferral even though they didn't need it. Tells you they're probably a really good credit risk and would really do as much as they can. So taking these pieces of information together will create much better segmentations. Hopefully you had the opportunity to watch Becky and when she talked about sort of surprise bankruptcies and the work she's been doing on that front. We've spent a lot of time recently understanding this segmentation and how do you think about credit profiles differently, both from a credit risk perspective, but just as importantly from a marketing and growth perspective. Thinking differently is going to be really important. What we know is this is a different time. We aren't really clear on the recovery. You saw from Doug's presentation, there's a lot of uncertainty that's going to happen over the next little while. There is a great opportunity for growth. It's how you go to market, it's how you identify it, and how you speak to the right customers that's really going to drive your success. I want to thank you for joining us today at Ignite Live. This is a really important event for us, and it's a great way for us to connect. We look forward to working with you to help you grow your business. We know this is going to be an interesting time, and it's not going to be easy, but we do believe we can support and help you however you need. Thanks for joining us today.